Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And this chain sheet should look pretty much like, it's roughly like any other chain sheet that we would look at. It's got strike prices down the middle, and I got calls on the left-hand side and puts on the right-hand side, bid and ask prices. Okay, so, and right now we know that the at-the-money price is about 116. So, and that's going to be right now. The spot price is a little bit off of that, but only by a few pips. So we're right on track. One of the approaches we could take to this is we could say, well, I have some exposure. I've got long exposure to the dollar franc in the spot market. So I'm trading the Forex, and I got some long exposure to the Forex spot market, long on the dollar franc, and I'm pretty bullish. But I want to provide a little bit of coverage, so I can borrow a strategy that equity traders have been doing for a long time and sell a call against that. And by doing that, I'm taking two uncovered positions, and I'm kind of limiting my risk by combining them with each other. So I'm working towards that, pulling a little bit of risk out of the market, a little bit of volatility out of the market by selling a call against it. So let's say, for example, that I were to sell the 117 strike price, so about 100 pips away or about $1 away, depending on whether you're looking at this in the spot market or whether you're looking at this as an option, as a Forex option trade. I'm going to get paid, about $1.68 or so. If I go back and look at my charts here, what that's basically done is it's giving me a little bit of latitude, a little bit of coverage. It's limiting my risk here on the in the spot market. I can draw a little line here. I've got, if the market were to drop a little bit, that time value that I've sold in that short call position, it's giving me a little bit of a hedge. So I know a lot of traders will refer to this as like contract neutral trading. So it's essentially a covered call. And what I've done is I've pulled a little bit of risk out of the spot trade, so I've got a little bit of coverage there, so that if the market, but if the market does go up, where my exposure is on that naked call, so I've got that short call position, the market does go up, well, I've limited that risk as well because I have an underlying spot position. So it's one of these ways in which the two markets and the two types of traders can really merge very effectively in a strategy that's fairly conventional and repeatable, has plenty of liquidity to be able to pull it off on a regular basis, and provides some of the same benefits that it would as if you were just an option or an equity options trader writing covered calls, for example. Now, one of the things we could do here, however, is we start to look at this position as we start to think, well, what if I'm not a spot trader? What if I'm not long the franc in the spot market? Can I replicate these same kinds of the same kind of position in just by using the options? And we definitely can. In a couple of ways, we can get really aggressive, or we can try to limit that risk a little bit. So let me show you what I mean. So, for example, SFC. If you don't know this already, a covered call and a short put have very similar risk profiles. So if you were to look at, the downside risk is very similar. The upside, you have a cap on how much you could earn on the upside with selling the put, limited the premium you sold. And just like with a covered call, you've got the distance from the spot price to the strike price plus the premium that you sold in the short call. So very similar risk profile. But you don't have to have exposure into both markets. So you don't necessarily have to have a long position in the market and selling a short call. You can just sell the short put. So, for example, let's say we were looking at the 116. So we're looking at the, or we could even get a little bit more conservative out here in the 114. So these puts are out of the money at the 114 strike price, and it would be paid, let's say, $1 for. That's the price right now. If we go back to our charts, I can move my little line here down about down to 114. That's our strike price, and now I can move down an additional $1. And where I've put myself is that I've basically got some exposure here at expiration or if we use expiration values, I've got some exposure down here around 113, which is right through the middle of that little gap there that occurred over a weekend. So we've got I think a reasonable level of support, and we're selling an option at about that provides us some protection to about that level. So it's one way to approach this. Now, if you're an options trader, we know that selling options is pretty attractive, but it does require typically you're having to leave on deposit some coverage, a balance to cover those against potential losses, and there are ways, of course, we can limit that responsibility as well as further limit our risk by shorting a vertical spread. So rather than just shorting the option itself, we could short a vertical spread, and it works almost exactly the same way as if we were doing this on a regular equity. So, for example, I'm going to go back to my little trade tab here, and I could get a little bit more aggressive here since I'm going to constrain my risk a bit. I could sell the 115s, but cover myself with a long position out in 112 or even the 110 range. So I know that a lot of order entry systems, everybody's a little bit different, but typically you can even put these in as a single order. So, for example, at the 115s, I'm going to sell. It'll open up a little pop-up menu for me where I can go in, I can sell a vertical spread, and then I can start to adjust, okay, well, what kind of, which strike prices do I want? How far out do I want that long position, and how much of a credit am I really shooting for here? Which is really the same strategy. What we're trying to do is we're selling that premium into the market. We're trying to get out of the money, and we're assuming that if the market doesn't necessarily go up a lot, what we're betting is that it won't go down a lot either. So it's just one way to approach the market in a way that we don't have to make a directional bet. That's one of the drawbacks, I think, with an outright long position in either the options or an outright long position in just the spot FX, is that they both have one fundamental problem. That is, in order to make any money, the market absolutely has to go up. But by selling an option and even covering it to limit our risk with a vertical spread, so for example, if we were to draw a couple of lines here, I'm going to push this one to 115, and then we were to say we're out the 110s. We've limited our risk, so we can't lose more than the spread here, the difference between the two strike prices, between 115 and 110 minus the credit. So it's just one way to approach the whole problem of not having to take as committed a directional bet. So I've got a question here that says, there's open interest in SFC. So what about the volume? And the spread's a little wide. Well, the spread is a little wide. And so I think that it makes more sense to, and I actually want to address that problem, the wide spread here, in just a minute, if I can, Jose. The second problem, however, is that I get this question quite a bit as far as open interest and such. And what I would say, the reason why I'm so jazzed about Forex options from the ICE is not because there's tons of open interest, but because the underlying, it's almost irrelevant, because the underlying market is so liquid. So it's not, in the equity market, typically when you have really low liquidity in the options, it's typically because it's a small stock. It's not a really actively traded stock. That's quite often the case. Well, that's not necessarily true in the Forex because you have such a huge, massive, you have a market, the underlying Forex market trades trillions of dollars a day. So it's the most liquid market in the world. And so that's one way I would address one of your concerns. And then I want to get to your concern about a wide spread here in just a second, because I think that's a great question, and it actually gets at one of the things we talk about in learning markets all the time is everything you learn about trading options, trading the Forex, trading stocks, whatever it is. So everything you learn about trading Forex options is applicable to not just trading a short-term option. So I've just been looking at the franc here from, March's expiration. That's not always the best way to approach the market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.